What's up, Luke? I'm excited about this one because we get this question all the time. Which burn rate should I use? Which burn rate is right? Did you know that there are multiple types of burns?
To be honest with you, before I started at Puzzle, I didn't know how many different types of burn rates there were or what was industry standard. So I'm excited to dive into this one too.
Yeah, let's do this. We get this question all the time.
Great. So the agenda for today, going to talk about what is burn, how can we calculate it, and then, of course, the most important thing, which one is right for you. With that, let's just dive in.
Yeah.
So what is burn? Lots of ways to think about it, but the metaphor that is most apt here is it's your jet fuel. So if you're building a rocket that is your startup, it is your jet fuel. And depending on how much fuel you have, that's how far you can go, whether you're headed to the moon or Mars. How do you like to think about it, Sasha?
Yeah. Once you burned your fuel, you're not getting it back. Once you burn your cash, you're not getting it back. At least not back cash.
Exactly. Which ties in directly to Runway. So Runway, this analogy isn't totally perfect, so just go with us here. The runway is essentially how far you can go before your business has to be cash flow positive or profitable on some level.
Or you got to fundraise again.
Yeah, that is the cycle, right? You either become cash flow positive or profitable, or you go to investors, or you have to go raise venture debt.
Or you shut down. Knowing your runway is really important because if you want to hit your goals, whether that's profitability or need to hit milestones because you're fundraising, you need to know your runway.
And is this something that you get asked a lot by investors? Is that a common thing?
It's the first metric that most founders who don't have any exposure to accounting and finance, it's the first metric. And so what you normally do is you go Google it and then you're like, wait a second, why are there so many different types of burns? What do they mean? You never want to go back to an investor and ask them, which burn did you mean? And they might not even know. I didn't even actually know that there were multiple ones before starting, but that's the fun of accounting and finance.
So on some level, this might even be more important than having your financial model or financials in place. Your burn is really that foundational number for fundraising.
Absolutely. I mean, this is how much oxygen you have in the room. So financials and accounting, especially in the early days, are a lot more for future compliance. It's what you need in order to fundraise. It's what you need in order to determine your valuation. It's what you need in order to pay taxes. It's what you need for other potential tax credits or tax benefits. But your burn or your runway is your life. That's how much longer you're going to live. So to me, it's sort of the most current in the early days metric of health. And you want to know it all the time. You can't wait until the month ends. And then you get your books closed and then you go calculate it. I mean, by the time you know it, it's a month or two later. And if that is a lagging indicator and you only have a couple months to live, that time is important.
Absolutely. Well, let's talk a bit more about an example of Runway. So if you had $1.2 million in the bank and we're burning, so spending net 100K, so you might be revenue. Either way, your net burn is $100,000. That would give you a 1-year runway. Is that
right?
fair?
And this, of course, exactly. This is your back of the envelope runway. This means sort of assuming no changes, or sometimes you'll hear a finance person say, "What's your run rated runway?" It's sort of the same thing today that goes forward. Why is that important? Well, of course, your business is going to change. You're probably going to hire more people. Maybe you let people go. You might start charging more revenue. But the simplest way is typically, if you don't make many changes, that's what can happen. And so it's the simplest way to think about life, assuming no changes. You don't have to hire more people. And so sort of what's happening today is usually the closest to indicative of the future.
Yeah, which I think we'll talk about a bit more when we go through examples of these different types of burns and whether we do like a 1-month average or last month. I guess that wouldn't be an average, would it? Or a 3-month average. So these are 3 common types of burn. So bank or gross burn or net burn and operating income. Which one do you usually like to look at?
I think net burn is usually the most common because, as we'll get into why. But a lot of people, the first mistake they typically do is look at gross burn.
Got it. Got it. Well, let's dive in then. So bank or gross burn, this at its simplest form is just the change in balance from your opening and closing cash. So if you had one Brex account or one Mercury account, it's purely your last bank statement. The opening close difference. If it was positive, then you would be cash generating. If it was negative, then that is your burn for last month.
Right. So it's sort of the simplest, how much cash actually moved out of your bank account. The next slide, I think, talking about net burn gives a little bit more context to why that might not be the most accurate way. While important, and to be the most accurate way, or the thing that you should look at.
Yeah. So an example might be you have $1.2 million in the bank, but last month you raised $1 million. So if we use bank burn, that's going to be pretty inaccurate for forecasting future operations or spending.
Totally. So let's just say your cash burn, right, is 100,000. Your business is actually burning or losing $100,000 in a month, but you raised $1 million, right? So your change in cash will be positive $900,000. Obviously, that would make you infinitely cash flow positive, but that's not truly indicative of the burn of the company. You're still losing $100,000, but the change in cash was $1 million difference, and that's typically a one-time thing as well. But those one-time things can really skew your numbers.
So if you had 5 different bank accounts and then got wires in from 5 different investors over 2 months because somebody didn't sign paperwork or wire the month that they said they were going to, this could become somewhat complicated.
Yeah, and it will get I think we'll get into a little bit of some timing differences and other reasons why why burn rate can be thrown off, and how to solve for that.
Sure. Well, let's talk more about operating income or loss and how that relates to either profitability and burn and why you might want to use it or not.
Now, this to me is one of the things that we're really trying to solve that puzzle. And as a repeat founder, is one of my biggest frustrations with accountants, and accountants' biggest frustration with founders, which is accountants like to work on an accrual basis or on a GAAP basis. And there's a lot of reasons why. It gives you the purest sense of financial health. There's tax mitigation benefits. But what it does is it changes the timing of how your money is moving to line things up to give you a better sense of sort of profitability and company value. The problem is by changing the timing differences, you're now obscuring the view of your actual cash of your business, which obscures the view of your runway. And so one of the biggest things that as a founder, like I want to see, aside from my traditional financials on sort of a GAAP accrual basis, is I want to see my burn. And so if we start looking at operating loss as like the way the business is like theoretically losing money, it takes into account the way that your business might actually be burning money.
Yeah. So if you're listening to your CPA and you're like, let's just do accrual-based books from the get-go, and that's your only metric you're operating off of, you might be managing toward profitability, but you could still not be cash flow positive and then run out of money, not be able to make payroll next month, but still be profitable.
Yeah, it happens more often than it should.
What happens, I get this question a lot, when your burn is wrong? I'm assuming you've probably heard that a lot from different people and maybe even investors trying to ask you why your burn is the way it is.
Well, freaks me out every time. It is not what I expected. And sometimes these things can be really, really large dollar amounts, right? Like every once in a while, not often, you might expect your payroll, if you pay sort of like twice a month, that it would maybe be pulled out on the 1st and the 15th or something like that. But sometimes it happens where it's the 1st, 15th, and 31st due to holidays or sort of bank timing ACH. And so you might have 3 payrolls hit one month and then one the other month. And that will wildly, usually payrolls, but 70, 80% of the money leaving your bank account, that can be a big timing difference, especially for software companies. Things are miscategorized. I think 2 common things that we hear all the time is like a safe might come in. Let's say you raise $100,000 safe or $1 million safe, or multiple safes, and they've been miscategorized accidentally as revenue. And so then it would go in where, as we talked about on a net burn, you would take investments like safes or equity investment or a convertible note out of your net burn. Unlinked bank transfers, meaning, let's say back to your example, you have 5 bank accounts and you're moving money from one to another. Well, it's still your money, right? Like you took that 1 million and moved it from this bank account to this bank account, but because of timing differences around a month end and the timing differences when it hits bank accounts, you might have like an unlinked transfer. I mean, you see one side of it, but the other side hasn't hit, so it might wildly throw off the amount of cash, which can affect your burn and affect your runway, or it might be categorized as an expense. And then timing differences. Like if you don't pay a bunch of bills, you're used to paying your bills every 2 weeks. And then you're on vacation, your bookkeeper's on vacation, you just don't pay it in time. And so you might have a bunch in 1 month that you pay twice as much the next month. And so these timing differences can mean your burn is wrong. The mathematical formula of burn is the same, but these can be scary big differences if you're just looking at one particular month. That might be sort of more volatile.
Yeah, so the solution there might be to look like at a 3-month average as opposed to just last month.
Exactly. Yeah, exactly. And so it's important to sort of, there's ways, if we go to the next slide, there's like what we did in Puzzle, it's just try and make this super easy, was we give you all three, like you don't have to choose which one, because they all tell you a slightly different story, but we also give you a 1 month and a 3-month average. So depending upon how much your business is changing, how much you're on top of your bills and your invoices, and potential timing differences, you can sort of see all of these differences just as long as you know how to click. And I think actually at the bottom, we just also added a custom burn one. So if you don't like any of them, or you just want to play around a little bit with like, well, what would my runway look like if my burn was this or this? You can enter in whatever number you want. It's automatically to calculate your cash, your burn, and your runway right across the top.
Yeah, I think that's an interesting example of taking the accounting data, which is very regimented, but applying a finance mentality of like, actually, I budgeted for that in a different month, so I'm going to move it with a custom number into a different month.
Yeah, cool.
Awesome.
Well, thanks, Luke. This is great.
Thank you, Sasha. If you have questions, reach out to us.